Breaking news that will reshape everything you thought you knew about precious metals. Silver just experienced its second worst crash in history, plummeting 32% in less than 24 hours, $115 per ounce to $78, the largest single-day drop since 1980. But this wasn't a random market event. This wasn't speculation gone wrong. This was something far more calculated. One presidential announcement, one name, and the entire global monetary system began repricing itself in real time. Gold fell. Bitcoin tumbled. The dollar surged. And while panic spread through trading floors worldwide, a silent group of strategic investors started accumulating aggressively. They understand something the broader market has completely missed, because what happened on January 30th, 2026 wasn't really about silver at all. It was a preview of what comes next. And if you're still watching, you already know that markets don't collapse without reason. Now, if you're someone who values real analysis over clickbait headlines, someone who remembers when financial intelligence actually meant something, do us one favor. Hit that subscribe button. Not for the algorithm, but because serious economic content shouldn't be drowned out by entertainment. And drop a comment telling us where you're watching from. New York, London, Tokyo, Dubai. We want to know where informed minds are paying attention. Now let's decode what really happened and why it matters far more than most people realize. January 30th, 2026. 9:30 a.m. Eastern Time. Silver is trading comfortably above $110 per ounce. Investors feel secure. The precious metal has been climbing steadily for months. Industrial demand is robust. Inflation concerns are driving safe haven buying. Technical indicators look solid. Everything appears stable. But seasoned traders know that stability in markets is often an illusion, a temporary equilibrium waiting to be disrupted, and disruption was coming. By 10:15 a.m., the first cracks appeared. A critical support level at $95 per ounce, the level that had held firm through multiple previous pullbacks, suddenly gave way. Trading volumes surged dramatically. Algorithmic trading systems began triggering automatic sell orders. What started as a technical breakdown quickly became a cascade. This is how modern markets operate. Price falls trigger programmed responses. Programmed responses create more selling. More selling pushes prices lower. The feedback loop accelerates. By noon, silver had breached $90 per ounce. And this is when the real destruction began. Margin calls flooded brokerage firms worldwide. Leveraged traders, those who had borrowed money to amplify their positions, were forced to liquidate. Not because they wanted to exit, not because their fundamental thesis had changed, but because they had no choice. When prices fall rapidly, brokers demand immediate cash deposits to cover potential losses. Traders who cannot meet these demands face automatic liquidation of their positions. This created a vicious cycle that would define the rest of the trading session. Forced selling pushed prices lower, which triggered more margin calls, which forced more selling, which pushed prices even lower. By 2 p.m., the $86 per ounce level collapsed. This was the secondary support zone that analysts had identified as the absolute floor, the line in the sand that shouldn't break, but it did, and the selling accelerated beyond anything most traders had witnessed in their careers. Electronic trading platforms designed to handle normal market conditions struggled to process the tsunami of sell orders. In some cases, there were no buyers at all. Let that sink in. Prices weren't falling because sellers found willing buyers at lower prices. Prices were falling because there were no bids in the market whatsoever. This is what traders call a liquidity vacuum, and it's one of the most dangerous conditions that can emerge in any market. By market close, silver settled at $78 per ounce, $37 lost in a single day, billions of dollars in paper value erased, fortunes destroyed, trading accounts wiped out. But here's what made this collapse fundamentally different from ordinary market volatility. While paper silver prices on exchanges like COMEX were plummeting, something extremely strange was happening in the physical market. Dealers selling actual silver bars and coins reported that their inventories were being depleted rapidly. Premiums, the additional cost buyers pay above the spot price for physical metal, remained elevated. In some cases, they actually increased during the crash. Think about what this means. The futures market was screaming that silver was worthless, while the physical market was saying the exact opposite. This created a bizarre paradox that experienced analysts recognized immediately. In 1980, when silver crashed from $50 to $10, it was because genuine oversupply existed. The Hunt brothers had accumulated so much silver that when their scheme unraveled, real metal flooded the market. Physical premiums collapsed because there was too much supply. But in 2026, there was no such oversupply. Industrial consumption of silver had been growing steadily. Solar panel manufacturing alone was absorbing record quantities. Electronics production required constant supply. Medical applications were expanding. The fundamentals supporting silver demand had not changed. What had changed was something else entirely. At 3:47 p.m., just minutes before the closing bell, the answer arrived. A presidential announcement that would explain everything. President Trump had nominated Kevin Warsh, a former Federal Reserve governor, as the next chairman of the Federal Reserve, not Judy Shelton, the sound money advocate who had publicly questioned the legitimacy of fiat currency and advocated for a return to gold-backed money. Kevin Warsh, a man who had repeatedly called quantitative easing, the Fed's money printing program, a reverse Robin Hood policy that transferred wealth from ordinary citizens to financial elites. A man who advocated for balance sheet reduction, not expansion. A man who represented the end of unlimited liquidity and the beginning of monetary discipline. Within minutes of this announcement, the entire precious metals complex understood what had just happened. The era of easy money was ending, and the markets were repricing everything accordingly. But this was only the beginning, because what happened next would reveal a truth that most investors had refused to acknowledge. The entire monetary system was built on assumptions that were about to be tested. Kevin Warsh was not a household name. He didn't have millions of social media followers. He didn't write best-selling investment books. He didn't appear on financial television promoting trading strategies, but inside the corridors of central banking, his name carried serious weight. And when President Trump announced Warsh as his nominee for Federal Reserve Chairman, those who understood monetary policy knew immediately what it meant. The game had fundamentally changed. To understand why this single nomination triggered a 32% collapse in silver, you must first understand what the alternative would have meant. Judy Shelton. For months, speculation had been building that Trump would nominate Shelton to lead the Federal Reserve. And Shelton was different from every Fed chair in modern history. She had publicly questioned whether the Federal Reserve should even exist in its current form. She had written extensively about returning to a gold standard, a monetary system where currency would be backed by physical precious metals instead of government promises. If Shelton had been nominated, precious metals markets would have exploded upward. Why? Because a gold standard advocate running the Federal Reserve would represent an existential threat to the current monetary system. It would validate every argument that gold and silver were real money and that paper currencies were merely temporary substitutes. Traders had been positioning for this scenario. Hedge funds had accumulated silver futures expecting a massive rally. Institutional investors had quietly built positions. Retail buyers had been stacking physical metal in anticipation. But Trump didn't choose Shelton. He chose Warsh, and Warsh represented something entirely different. In 2008, during the financial crisis, Warsh had been a Federal Reserve governor. He had witnessed firsthand the expansion of the Fed's balance sheet from $800 billion to over $4 trillion. He had seen quantitative easing programs flood the financial system with newly created money, and he had become one of its most vocal critics. In speeches delivered to banking conferences, Warsh had called QE a policy that taxes savers and laborers to subsidize debtors and financial market participants. He had warned that unlimited money creation would eventually destroy the credibility of the dollar itself. He had advocated for what he called rules-based monetary policy, a system where the Fed would not arbitrarily decide to print trillions of dollars whenever markets declined. This wasn't theoretical economics. This was a direct threat to the entire framework that had supported asset prices for over a decade. Since 2008, every major market decline had been met with the same response. The Federal Reserve would print money, buy bonds, inject liquidity, and asset prices would recover. Investors had been trained to expect this. It became known as the Fed put, the implicit guarantee that central banks would always intervene to prevent sustained declines. But Warsh had explicitly rejected this approach. In a 2019 research paper, he had written that central banks should allow markets to function, even if that means enduring painful adjustments. He had argued that constantly preventing downturns only created larger bubbles that would eventually cause greater damage. And now this man was being nominated to control the world's most powerful central bank. The implications were staggering. If Warsh was confirmed, the Federal Reserve might actually allow its balance sheet to shrink. It might raise interest rates even during economic weakness. It might refuse to bail out failing institutions. For precious metals, this created a complex paradox. On one hand, sound money policies should theoretically support gold and silver as alternatives to debased fiat currency. On the other hand, if the Fed stopped printing money, the immediate effect would be a liquidity drain across all assets, and markets always react to immediate effects first. Within 30 minutes of the Warsh nomination, gold fell 8%, Bitcoin dropped 12%. The dollar index surged to its highest level in 18 months, but silver fell hardest of all. Why? because silver occupies a unique position in the market. It's both an industrial metal and a monetary metal. It's used in manufacturing, but it's also held as a store of value. When liquidity contracts, industrial demand forecasts decline, and investors who were holding silver purely for monetary speculation exit their positions. The selling was indiscriminate and brutal. Futures traders dumped contracts, ETF holders redeemed shares, leveraged positions were liquidated without mercy. But something else was happening simultaneously. While paper markets were collapsing, a different group of participants was watching quietly. They weren't traders. They weren't speculators. They were strategic accumulators. These individuals and institutions understood that Warsh's nomination, regardless of its immediate market impact, represented a fundamental shift toward monetary discipline. And monetary discipline over time always benefits hard assets. They had been waiting for precisely this moment, a panic-driven sell-off that would allow them to acquire physical metal at artificially suppressed prices. While futures contracts were being dumped in desperation, physical silver was being quietly absorbed by informed buyers. Dealers reported unprecedented buying activity from what they described as sophisticated clients. The paper market said silver was collapsing. The physical market said something completely different. And this divergence was about to become the most important story in global finance. Because what happens when paper prices fall but physical supply disappears? That question was about to be answered in dramatic fashion. There's a game being played in financial markets, and most participants don't even know they're playing it. Let me describe how it works. Imagine a casino where 1,000 people place bets on a stack of 100 poker chips. Each person receives a receipt, a promise that they own chips. The casino collects fees on every transaction. Everyone trades these receipts back and forth. Prices fluctuate. Fortunes are made and lost. But here's the critical detail that makes the entire system function. Only 100 chips actually exist. The system works perfectly as long as no one asks for their chips. The moment even 15% of receipt holders demand physical chips, the entire structure collapses instantly. This is precisely how the modern silver market operates. And on January 30th, 2026, people started asking for their chips. The COMEX, the Chicago Mercantile Exchange, handles the majority of global silver futures trading. On any given day, contracts representing hundreds of millions of ounces trade hands. The total value measured in billions, the leverage extraordinary. But examine the actual delivery statistics and a very different picture emerges. Less than 2% of COMEX silver contracts result in physical delivery. Less than 2%. The remaining 98% are settled in cash, rolled forward to future months, or closed out before expiration. The silver referenced in these contracts never moves, never leaves the vault. Sometimes never even exists. This creates what economists call a fractional reserve system. The same ounce of physical silver sitting in an approved vault backs multiple paper claims simultaneously. One bar supporting 10 contracts, 100 ounces supporting 1,000 ounces of paper exposure. The leverage ratio, conservatively estimated, sits somewhere between 100 to 1 and 250 to 1. Read that again. For every actual ounce of deliverable silver, the market has sold promises on 100 to 250 ounces. Now, under normal circumstances, this system functions smoothly. Most traders don't want physical metal, they want price exposure. They want to speculate, hedge, arbitrage. The casino keeps running because most people are content trading receipts. But January 30th was not normal circumstances. Something shifted in the physical market that sent warning signals through the entire system. Industrial buyers who actually need silver for manufacturing started securing supply earlier than usual. Eastern central banks quietly accumulating precious metals, accelerated purchases. Wealthy individuals growing concerned about currency stability began converting paper positions into physical holdings. The requests for actual delivery increased, not dramatically, not even to 10% of open interest, but enough to expose the underlying mechanism. Because here's what happens when physical demand rises in a fractionally reserved system. The bullion banks who operate as intermediaries face a critical choice. They can either source physical metal to meet delivery requests, which drives up the spot price and exposes their short positions to massive losses, or they can suppress the price through coordinated selling in the paper market, making physical silver appear less attractive while simultaneously making it harder to obtain. Industrial consumers, companies that actually use silver in manufacturing, were accelerating their purchasing dramatically. They understood something crucial. Paper market dislocations create supply chain vulnerabilities. When prices are artificially suppressed, mines reduce production, refiners slow operations, future supply contracts become unreliable, so they were buying aggressively in the physical market. Solar panel manufacturers were securing 6-month inventories instead of their usual 30-day supplies. Electronics companies were locking in forward contracts at any price. Medical equipment producers were stockpiling silver as if preparing for a supply disruption. Strategic buyers were also entering the market in force: sovereign wealth funds, family offices, institutional investors with 10-year time horizons. These entities were not concerned with whether silver would be $75 or $85 next week. They were concerned with whether they could acquire thousands of ounces at prices disconnected from fundamental value, and they were buying as aggressively as supply would allow. But there was a significant problem emerging. Physical silver is not infinite. Annual mining production is approximately 830 million ounces globally, but 85% of that production is already contracted to industrial users before it even comes out of the ground. The amount of silver available for investment purposes, the free float, is actually quite small, and when investment demand surges, as it was doing on January 30th, the free float disappears rapidly. Refiners in Switzerland reported backlogs extending 6 weeks. Mints producing coins announced significant delays. Wholesale dealers began rationing allocations to smaller retailers. The paper market was screaming abundance and collapse. The physical market was screaming scarcity and value. This divergence has happened before, and understanding the historical pattern is critical. In March 2020, during the COVID panic, silver futures briefly traded below $12 per ounce. Yet physical silver became almost impossible to buy at any price. Dealers were completely sold out. Premiums exploded to $10 over spot. The paper price said silver was worthless. The physical market said the exact opposite. But in 1980, the pattern was completely different. When silver crashed after the Hunt brothers collapse, physical premiums collapsed too because there was genuine oversupply. Real metal flooded the market. But in 2026, there was no oversupply. There was only a derivatives market repricing based on monetary policy expectations, while the underlying physical market operated in a completely different reality. And this created either an opportunity or a trap, depending on who you were and what you understood. For paper traders using leverage, the collapse was absolutely catastrophic. Margin calls forced immediate liquidation. Positions were closed at devastating losses. Fortunes evaporated in hours, but for physical accumulators, the collapse was a gift. Prices disconnected from fundamentals created the buying opportunity they had been waiting for. Yet there was a third group that faced the most dangerous position of all: those who didn't understand the difference between paper and physical. Investors who owned silver through ETFs, through digital certificates, through allocated accounts at banks. They believed they owned silver, but what they actually owned was a promise that if they ever wanted physical delivery, someone would provide it. And that promise was about to be tested in ways that would expose the entire fractional reserve structure. The 32% collapse in silver was not an ending. It was a warning shot. A signal that the monetary regime which had governed global markets for over 15 years was entering a terminal phase. And those who understood what was really happening were making decisions that would determine their financial outcomes for the next decade. There were two distinct groups watching the chaos unfold on January 30th, 2026. They were looking at the same price charts, reading the same news, observing the same market dynamics, but they were reaching completely opposite conclusions about what it all meant. The first group consisted of traders, individuals and institutions operating on short time horizons, days, weeks, perhaps months. They were managing leverage, monitoring technical levels, calculating risk-reward ratios with precision. For them, silver breaking through the $90 support zone was an unambiguous sell signal. The failure to hold $86 confirmed bearish momentum. The collapse to $78 validated their decision to exit positions immediately. Their stops were hit, their positions were closed, their capital was preserved. From a tactical trading perspective, their decisions were absolutely correct. Because in leveraged markets, survival requires cutting losses quickly and decisively. A trader who refuses to exit a losing position, hoping for a reversal, often faces complete destruction of capital. But there was a second group operating with an entirely different framework: the accumulators. These were not traders in any conventional sense. They were not watching hourly charts. They were not concerned with whether silver would close above or below a particular moving average. They were operating on a completely different time frame. Years, decades, generational wealth transfer. For this group, the 32% collapse was not a crisis requiring immediate action. It was an opportunity they had been strategically waiting for. They understood something fundamental about monetary systems that most people refuse to acknowledge. Fiat currencies, money backed by nothing except government decree, have a 100% failure rate throughout human history. Not 90%, not 95%, 100%. Every fiat currency ever created has eventually collapsed. The Roman denarius, the French assignat, the German paper mark, the Zimbabwean dollar. The average lifespan of a fiat currency is 27 years. The US dollar in its current form, disconnected from gold since 1971, is 55 years old, already double the historical average, and the policies that had sustained it, unlimited money printing, zero interest rates, perpetual bailouts, were being questioned by the incoming Federal Reserve chairman. The accumulators understood that Kevin Warsh's nomination represented an attempt to restore fiscal discipline to a system drowning in debt. But they also understood something else that most analysts were missing. The system was too far gone for discipline to work without catastrophic consequences. The U.S. national debt exceeded $36 trillion. Unfunded liabilities for Social Security and Medicare exceeded $200 trillion. Corporate debt was at all-time highs. Consumer debt was at all-time highs. The entire economic structure was built on the assumption of infinite liquidity, and Warsh was proposing to turn off the tap. What would happen? The accumulators saw only two possible outcomes. Either Warsh would succeed, which would trigger a deflationary collapse that would eventually force a return to hard money and sound monetary principles. Or Warsh would fail and be replaced by someone who would restart money printing on an unprecedented scale that would make previous QE programs look modest. Either way, physical precious metals would eventually benefit dramatically. The accumulators were not buying silver because they believed prices would rise next week or next month. They were buying because they believed the monetary system itself was entering its endgame. And during that endgame, holding claims on physical assets would be vastly superior to holding claims on currency that could be printed into existence without limit. But strategic positioning required understanding the critical difference between paper and physical silver. Paper silver, futures contracts, ETFs, digital certificates offered liquidity and convenience. You could buy and sell instantly, but they also carried counterparty risk, the risk that the entity promising delivery would fail when tested. Physical silver, actual metal in personal possession, offered no counterparty risk whatsoever, but it offered limited liquidity during panic selling events. Sophisticated accumulators were structuring their positions to benefit from both approaches. They were building core positions in physical metal, bars stored in secure vaults, coins held personally, assets that could not be confiscated by a brokerage margin call or financial system disruption. But they were also maintaining smaller tactical positions in paper markets, positions sized appropriately for extreme volatility, positions that could be liquidated without emotional distress if necessary. This hybrid approach allowed them to benefit from multiple strategies simultaneously. The physical holdings provided long-term security and protection against systemic failure. The paper positions provided short-term tactical flexibility and the ability to benefit from price movements. But there was a third consideration that even the most conviction-driven accumulator had to acknowledge: timing. Markets can remain irrational longer than individuals can remain solvent. Silver could fall further from current levels. The $78 level that seemed like an extraordinary gift on January 30th might be $60 by mid-February. Strategic accumulators addressed this uncertainty through systematic buying protocols. Rather than deploying all available capital at once, they were averaging into positions over time. Buy some at 78. If it falls to 70, buy more. If it falls to 60, buy even more. This approach eliminated the psychological pressure of timing the exact bottom. Because the truth that nobody wants to acknowledge is this: nobody knows where the bottom is. Not the analysts with their charts, not the traders with their algorithms, not the central bankers with their models. Markets are complex adaptive systems influenced by thousands of variables interacting in unpredictable ways. What strategic positioning provides is not certainty about the future. It provides resilience, the ability to withstand extreme volatility without being forced to exit at the worst possible moment. And on January 30th, 2026, as silver collapsed 32%, two very different groups were positioning themselves for completely different outcomes. One group was protecting capital by exiting positions and preserving liquidity. The other group was deploying capital by entering positions and acquiring assets. Both were making rational decisions based on their time frames, their objectives, and their understanding of what was really happening. But only one group understood the deeper truth. The collapse in silver was not about silver. It was about the transition from one monetary regime to another, from unlimited liquidity to imposed discipline, from paper promises to physical reality, from faith in central banks to faith in elemental metals that have stored value for thousands of years. This transition would not be smooth. It would not be predictable. There would be rallies that failed and disappointed buyers. There would be declines that seemed to validate the skeptics and the cynics. But beneath the surface volatility, the fundamental dynamic was irreversible. The era of easy money was ending, and those who prepared accordingly, who understood the difference between temporary price movements and permanent systemic shifts, would be positioned for what comes next. Not because they could predict the future with certainty, but because they understood the past. And history, when it comes to fiat currencies and precious metals, has only ever told one story. That story has repeated across civilizations, across continents, across thousands of years. The question facing investors today is not whether that story will repeat again. The question is whether you will be ready when it does.